Inflation and mortgage rates unpacked in 60 seconds. So, what is inflation? Inflation is the gradual increase in costs over time. Who controls inflation? The Federal Reserve does their best to keep it in check. What do? So the Federal Reserve has a couple levers they can pull. The primary one is the overnight rate. This is when everybody talks about the Fed is raising rates or cutting rates. They're talking about this overnight rate, which is the rate that banks borrow from one another at overnight to meet their cash reserve requirements. When this rate goes up, it directly affects the cost of auto loans, credit cards, HELOCs, things like that, because those are things that are directly in control of the banks. Now, mortgage-backed securities are the next step, and those are speculative, right? So when we see inflation numbers come out and the Fed starts talking about, oh, we're going to raise the rate or we're going to cut the rate, the mortgage market sniffs that out in advance and prices that into mortgage rates in advance. So even though the Fed doesn't cut their rate, we might see mortgage rates go down because they expect a cut's coming, or vice versa. There it is in 60 seconds. Let me know if it helps. Thanks.